Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to look at the economy, and we're going to look at it globally as we always do, and we're going to start with COVID cases, what's happening with COVID and mobility, and how is that impacting Europe and other areas when we start thinking about the economic impacts. Then we're going to go further into some leading indicators around the world. What does it mean, and what does that indicate for what we're thinking for Q4? Then we're going to go deeper into the U.S. economic, looking at what is happening with the consumer, jobs, our favorite topics. And then we're going to look at more of a global bend when we start factoring in OPEC and some of the other leading indicators within Asia. So, before we get started, please, we always appreciate if you like, share, subscribe. These are things that help us. Your comments are always welcomed. We've gotten some great comments, especially in the EIA show recently. And so anything that you can add, share, give some of your views, it's all welcome. So now that we've covered that, let's just dive right into what's happening in Europe right now. So here you can see what is really driving some of these decisions on lockdowns and other types of curfews. It's really the death rate. And when you see the increase in deaths, here you can see that the biggest component is the European total, which continues to creep higher. Now, this is still going to be the biggest driver behind what is going to push a government to action. Because as we've been talking about, as we described in the EIA show, when we really started highlighting what is happening with cases, the case counts that are increasing, that's going to change consumer behavior. But when we start thinking about taking action, you have to consider deaths and underlying hospital infrastructure, ICU care. Those are things that are going to drive more hard-lined action, if you will. So that's something to watch, specifically as some of these different areas start to see an increase in cases, and then that'll always lead to an increase in hospitalizations. But luckily, at least in the U.S., it hasn't been as severe as previously experienced through the beginning of the, let's call the late spring, and then when we got into summer. So one of the interesting things that we have found is you can actually start looking at symptoms, where people are Googling what are the symptoms, whether it's anosmia, which is the inability, the lack of smell, because people who get COVID are experiencing no smell, no taste, given the two are connected. And then fevers. And these are types of things where you start to see an increase in searches prior to cases, because people will search it, see what it could mean, and then go get tested. So typically this is a little bit of a leading indicator for where we're going to start to see some increases in new cases. So it's something to watch, and you can see obviously Germany, Russia, Belgium, Italy, Czech Republic, and Poland. And as we talked about in the EIA show, those were some of the key areas that we started to see a big increase in cases, which just based on what this chart is telling us, it's only going to ramp up as we go through the remainder of November. So when we start looking at what's happening in the actual, so that was globally and specifically in Europe. Now let's look at the U.S. What's happening in the U.S.? And you're starting to see those symptoms, the same type of increase. Now, we talked about in the EIA show the Midwest, because the Midwest is a big part of what we think is going to continue to get worse. And when you look at the Midwest and how things are shifting, we've seen an increase overall, and it's going to be a problem when you start to consider driving, mobility, because the Midwest is one of those bigger areas in terms of where we see the most driving activity and the longest round trip to the store. But you can see it's starting to increase pretty much across the board. The Northeast, we expect to start to get worse as people move indoors, as it gets colder. But it's of no surprise to start to see some of these increases in Central Plains, Midwest, Mountain, just because obviously it gets colder there sooner. So then people are indoors and they start searching some of those symptoms. Now, the different cases continue to rise. The two biggest are obviously North America and Europe, where we've seen those cases increase across the continent. That's something that we don't think is going to stop. Europe, we're hoping now that we have some lockdowns, we have some of these adjustments, you'll start to see some of that roll over and you'll start to see the case count slow. Just given based on the symptom searches, this probably won't slow immediately. We'll probably see an increase through at least the middle of November, then start to roll. North America is one where we'll probably continue to see an increase as more people go indoors. Now that we've kind of talked about what is this, what's happening with COVID, now how does this impact the market? What is this going to do to the underlying economy, which is why we always like to look at these daily indicators. So France, you can see how precipitous that drop was, and how quickly things can react, which is why when we start talking about GDP expectations, and this is one of the reasons why we were concerned coming out of Q3 into Q4, is just because we saw an increase in cases and we were expecting to see some impacts. Now, the severity of those impacts was going to vary just based on what's going to happen with lockdowns, deaths, hospitalizations, and here you can see the rollover here. Now, Japan remains fairly flat. That's one that is struggling under other economic conditions. And we'll talk about some of them specifically as we've been talking about with production, retail sales, exports, imports. But here we're starting to see those pressure increasing. Specifically, obviously, France is the biggest one coming down. Sweden, Italy. We're starting to see some of these slowdowns, and then the U.S. as well. We're starting to see some of that drag that we've been talking about, where we expected Q3 to finish strong. But as we looked at October, in terms of starting October strong, finishing a bit weaker, and what that meant going into November, it's really starting to show up in the data now. So we've had some leading indicators, and now the charts are starting to reflect it a bit more aggressively. And these are things that are going to continue to weigh on just what is happening across the developed world. Now, looking at the developed markets, we then have to consider, well, what is happening in the emerging market land? And here you can see the emerging markets have been pretty steadily increasing overall, which has been a net positive. The bigger issue remains for us is India, because India had a nice little spike. It kept going up. And now we're starting to see India slow back down a little bit. And it's just going to come down to what's happening with the festival. How did we finish into the end of the year? And this is just, it's not something where, unless we get a really big increase in Indian cases, we think that it's just going to essentially hold here and maybe come down a little bit. Only because when you start looking at emerging markets, you have to consider, well, what's happening in the developed markets, because developed markets have obviously strong relationships in terms of whether it's semi-finished goods, raw materials coming from the emerging markets. So developed markets will slow, then emerging markets will start to reflect that as trade dwindles. So this is something where we think there's going to be a little bit of a slowdown, but the key ones to watch are always going to be China and India, just given their sheer size and weight. And those are ones where we think that you're starting to see a little bit of a rollover in India, and China is going to face some problems as we go through the remainder of the year, which we'll talk about. Now, just looking at it as an aggregate, just to kind of put it into perspective, obviously, when we start looking at emerging markets, advanced markets, you're starting to see the global side turning over a little bit, and it's really being pulled down by advanced economies as they continue to see their own increases in COVID cases, and that's resulting in additional lockdowns and slowdowns overall. So when we start looking at the global manufacturing PMI, you have to consider, well, this is a survey, there's a certain amount of input, and we have to consider the different components, because each component is going to have a different weight and it can mean different things going forward. So when we start looking at some of these leading indicators, we like to look at the components that make them up as well. So on a global manufacturing level, because the one thing that we've seen is manufacturing has really outpaced services, and it's interesting to look at the two, and you want to look at them separately because you want to appreciate some of those different factors. So when we look at manufacturing PMI, you can see that we're back into an expansionary territory. It's starting to slow, but it doesn't mean that we're going to go negative again. It just means that the pace of the increases is starting to normalize. And now with some of the COVID cases and lockdowns increasing, we'll see some of that roll over. Now, supplier delivery times has gotten better. We've talked about that with trucking, with rail, and that's something that will continue to improve. But the bigger thing to watch is going to be new orders, which have gotten stronger, which is good in terms of maintaining some of this manufacturing output. But the bigger overhang remains employment and inventories. So inventories are starting to normalize, which is going to slow down some of the purchasing. But it really comes down to employment, because we're seeing that slow, where people are learning to do more with less. And that's why when we talked about in 2019 into 2020, we saw this overhang with employment where people were, potentially going to lose jobs, and you were starting to see some of the slowdown. And that's starting that's remaining in the market, which is why we talk so much about jobs, because even though we've seen an increase in some of these the PMI data and some of the underlying economic growth, it's really not translating into a growth of employment. Now, don't get me wrong, it's obviously come strong off the bottom, but we're still not back into that expansionary territory, which is going to be a problem when we start to think about the longevity or the length of time that we're going to experience some of this overhang, which we continue to talk about, where we see issues essentially spanning well into 2024, just given where we see the world in a stagnating type of situation. Now, when we start to look at some of the different backdrops overall, and this is just looking at the U.S. in terms of where things are on manufacturing output, because obviously there's different pieces, and we'll go through in a bit more detail in the next segment. But here you can see the output index continues to get to surge to the upside. But the PMI output index has started to slow down a bit. And again, it comes down to that rolling over where the slope is just not as intense. You're starting to see some of those headwinds and the manufacturing output. Now, it's just important to look at the output index has outpaced some of the actual data and has been a little bit early. So here you can see the manufacturing output still remains slow, which we'll talk about again in the next segment as well. But you're starting to see some of that recovery, but we're starting to roll over a little bit and starting to cap that, which we think is going to only increase into Q4. Or I should say through the remainder of Q4, as some of the activity throughout the U.S. Cools off. And that's not something that is unique to the U.S., because obviously based on some of the data that we showed with the daily activity, it's also something that is occurring in Europe as well. So when we start talking about, okay, well, we talked about Europe, we talked about the U.S., well, what's happening with Northeast Asia? What's happening in Asia in general? And here you can see that China has seen some of this flatlining, where Taiwan continues to be very strong. They've had an increase in semiconductors. They have had an increase in total throughput, and Taiwan remains one of those bright spots, where China has seen a little bit of a cooling. Again, how much of the data can you agree with? But again, we think that it's a little bit lower than what they're experiencing. Korea is one where it's recovered strong off the bottom, but we're starting to see some of these headwinds that is going to keep it just within a margin of error. So our view is that between 48 and 52, obviously below 50, you're contractionary, above 50, you're expansionary, but there's also a certain semblance of aggregating those numbers. So when you're within those 2 points below and above, you're kind of stagnating and waffling in between kind of nothing here. And here, and Korea is falling within that, and we think that we're starting to see some of that slowdown, again, coming back to the slowdown in some of their key export markets, which is starting to struggle, which is going to keep them relatively capped at this point. So then when we start looking at the global manufacturing new orders and exports, because when you talk about China, Taiwan, South Korea, Japan, Germany, it really comes down to exports. They're an exporting economy. So what is happening overall? So orders are going up, but we're starting to see export orders roll over. And as we've been talking about, especially in the EIA show, is that when we look at global trade, there remains a lot of headwinds over that period of time, where some of that trade is starting to cool off. And that's really because inventories have normalized a bit. And now you're starting to see those impacts from either additional cases or just the economic headwinds that persist with limited jobs, with people, conserving capital, which is going to keep those export orders, slowing. Now, do we think export orders are going to come below 50 again and show a deceleration? No, on a global aggregate, but in specific areas, we think that there will be an overhang that's going to send it below 50, which is going to keep that weighted, closer to and waffling between that, let's call it 48 and 52 over the medium term. And this is what we're talking about when we think of global exports, because the global PMI numbers have actually gotten better, but then the merchandise volumes and annual percent change continues to remain fairly weak. Now, typically the PMI will lead the volumes, but COVID is a very unique case. And the fact that we've seen global PMI new orders starting to slow means that we think there's going to be a continued headwind in that merchandise volume as we continue to talk about and looking at specific tells in terms of mobility, which is why we keep talking about those daily activity indicators, rail as well as shipping, and then trucking as another key component within the U.S. But as we continue to talk about that foot traffic, toll miles in key markets that we're using as those bellwethers. And then, this also breaks out what's happening with employment on those order backlogs. So as we've seen, the order backlogs have gotten better. Those new orders have gotten better, but employment isn't matching. And again, this comes down to doing more with less, which is going to slow down the recovery, because what is a big part of GDP but consumer purchasing? And without consumers purchasing as much, just because they're either fearful of losing their jobs, have lost their jobs, don't see strong prospects, this is going to keep things relatively capped overall, which is just going to be a concern as we head into the remainder of the year. And when we start looking at GDP assumptions, when we consider GDP assumptions, we're looking at what is changed. And these continue to worsen, obviously, as lockdowns come into effect with new shifts lower, as we consider what's going to happen into the end of the year. And you can see that even though we have this lockdown, which is kind of being priced in with these shifts lower, the question is going to be how quickly do we get back to where we were prior to COVID? And you can see kind of that long, slow grind back up. And the reason why we're going to have that headwind is just because we've already accelerated a significant amount of purchasing on the government level, the central bank level, and then jobs. Again, it's always going to come back to how quickly can we get people employed, and that's really where we're seeing the biggest headwind of where can we see this new activity, which is why we remain concerned overall with the GDP trajectory. And given we have a very interesting election right now, which we'll cover a little bit, but until we have more information, we're not going to go too in depth, because at least I'm not a political analyst, so I'm not going to opine too much. But clearly there is something to be said about what does this mean for stimulus? What does this mean for the Fed bank, and what does the Senate and House do now that we have a little bit of a disappointment from a Democratic side when you consider the Republicans maintaining the Senate and the Democrats losing some seats in the House, even though they're going to retain control. So those are things that we'll talk about throughout the next few segments.